Welcome back to the Steps to Soul podcast. Today, we're talking about why you need to get your business ready and SBA financeable, and also the new regulations for the SOP that go into effect October 1st, 2026, and why you need to be ready for those. Because, Chris, there are some changes coming, whether we like them or not. The SBA said so, and there's actually, for the first time in a while, some new things introduced that aren't reverting back to the old rules, but actually new twists that, as a business owner, especially for ones in that upper end of Main Street or part of the lower middle market, they're going to affect you most of all. Isn't that right?
Yeah. Going to affect business owners, business buyers, going to affect lenders, right? Lenders got
Greatly.
to adjust to these things, and we've all got to adjust accordingly. So lots of adjustments to be made in the marketplace here soon.
You're right. Quick teasers for those who want to know: $3 million and up business valuation size, whole new requirements, debts covered service ratios have gone up, cap on seller notes, investor equity, standby debt, and 10% equity injection floors, and changes for how they view the transaction. There's 4 types now, how they're going to kind of consolidate these rules, and they're all different for each 4 categories. So we're going to cover all that a little bit later. But first off, in the main point, let's talk about why it's important you get SBA financeable. Because if you don't know why it's important, you won't understand why the new changes are going to affect what's going on. So at further ado, let's just jump right into it. Most businesses that get financing today use SBA loans, Chris. I know people say go get your usual bank, go get conventional loan down the street. That's a very small percentage of them. The large majority of business transactions use SBA, or in some capacity use SBA, whether it's real estate based, real estate and business acquisitions, or just a straight business acquisition. I'd say even more so for pure business acquisitions, SBA dominates in that space. So what does SBA financeable mean, Chris? It's real simple. Can the SBA underwrite the loan and insure the bank to make the loan to you? Remember, people, the banks make the loan. The SBA doesn't. The SBA just insures the bank. So the bank has a fully collateralized loan. As you and I know, Chris, banks don't do anything but fully collateralized loans. When you go to buy a house, they get an appraisal. They give you the money for the exact value of the house. With a business, there could be blue sky. There may be less value than the assets for what the purchase price is. That's where the SBA fills those gaps that conventional banks don't want to dive into, correct?
Yeah, absolutely. And there's 3 parts to this story. There's something I've learned over the years. There's always 3 values to a transaction. There's what the seller believes the business is worth, right? There's what the buyer's willing to pay. And none of that really matters if the lender's not willing to finance on that value. And that's the most important part. You and I, Brandon, we can get the first 2 parties, the buyer and seller, we can get them completely aligned on what you're willing to sell it for, what you're willing to buy. But if that third party, the lender, most important part of the process usually, if they come in and say, no, we're not agreeing to that, the whole process doesn't work. I think what we're talking about today, these new rules make that number 3 guy, the lender, they make that even more important to make sure it's done right up front. So I think financing analysis and all the things that you and I do up front, recasting and making sure, checking through P&Ls and balance sheets, the analysis of those materials needs to move much earlier in the sale process than it traditionally does. You have to start with that almost if you weren't already starting before, because it's become a little tighter to borrow money from the SBA. They've increased the debt service coverage ratio, which we're going to talk about. They've got some new rules we're going to talk about. And so financial analysis is a lot more important than it even was before.
You're right. And another third party now enters the deal, and we'll discuss that a little later too, especially for those larger transactions. And that's where it gets important. The SBA, what does it provide? Expanded buyer pool. With that comes more things you have to accomplish to get the loan done. We stress to business owners, when your business is SBA financeable, it's going to open your buyer pool up. It expands the minimum amount of capital needed to a 10% equity injection. It also expands the buyer base and radius to do a deal. Because like you said, Chris, and we talk about it all the time, most people don't walk through the door with a full bag full of cash wanting to pay all cash for a business. Most business owners want to leverage their cash. That's where the SBA becomes a gigantic tool to do so. And too often, owners hope that guy with the bag shows up and just gives them $1 million, the magic number. The problem is, most people who have that amount of money aren't going to invest it like that. So you need someone who's maybe got $100,000, $200,000, $300,000 in saved up capital that can put $100 down to buy $1 million company at 10% equity injection. Boom, you're in business. And just because your business is not SBA financeable does not mean that it's not good. The problem is, we're talking about today, get it to where it can be SBA financeable, expand your buyer pool so when the time does come to sell, you can exit. Or if not, you have to leverage seller financing or a couple creative ways to do it, which is not always the easiest thing to do, unfortunately. And that happens all the time. And let's talk about the other benefit of the expanded buyer pool. When buyers see an SBA pre-qualified business, Chris, you and I know, it makes them more excited. It makes them feel more confident. Why? You mentioned best. The third party has at least looked at it to some degree. They have not done a colonoscopy on it. They have not done a full audit. But the banker has said, yes, I feel confident based on the cash flow projections, based on the recast, what the broker's provided, what I've gotten information on, I can do a loan on this deal based on the buyer meeting certain criteria as well. And for owners that are listening and buyers, these are the deals you want to do, because if an SBA bank is willing to fund that deal, there's a very good chance that's a good business to buy. Doesn't mean it's perfect, Chris, but you and I know when they're financeable and the bank third party signs off on it and the seller agrees to a price and the recast is there, those are typically pretty good deals and ones you should pursue versus ones where there isn't good bookkeeping or there aren't good records and they can't be financed. Because there's a good case in some of those deals, they're bad business. Doesn't mean that always bad books are not bad businesses. It's not a direct correlation, apples to apples. But as you and I know, Chris, when the books aren't good enough and the lenders won't do it, that really makes it tough it kills confidence at times, doesn't it? It makes it brutal.
Yeah, because I mean, everybody can be qualified. The business can be pre-qualified. The buyer can be pre-qualified. But if it's not going to make sense at the end of the day for this business and the finances and the debt service coverage ratio, I always come back to what are we even doing here? You know, what kind of deal are we putting together? And vice versa. If I've got two offers from two different buyers and they're coming in at the same time and they're pretty similar, what am I doing? I'm looking at, hey, which banks are you guys using? Are you going local, trying to go local, regional versus SBA? And if I've got this business SBA pre-qualified and this buyer number 2 is coming in with a SBA offer, he's willing to go SBA, I've got to advise my client, hey, we've got to go with this. It's been pre-qualified. He's been pre-qualified. Everything's lining up. This guy wants to go with his local regional banker because he's got a good relationship. But they haven't even looked at the deal yet. They're just going to start looking at it. So, Brandon, I'd ask you this: when you're comparing offers like that, how much weight do you personally put on the certainty of financing and the SBA versus simply taking the highest purchase price and advising your clients which route to take?
That's probably the second most important thing behind, is this buyer the better fit too? Like if there's a better buyer, different route, that's a great fit with licensing and other criteria. Yes, you want to look hard at that buyer. But the next thing is, can they get the deal done? And financing is a huge component of that in most cases. And to reiterate upon your point, the local bank. Yes, there are some good local banks that can do loans. However, I want to reiterate this to everybody listening. Any bank can make an SBA loan. It's the key is using a preferred lender. As you mentioned, to pre-qualify, Chris, the buyer. Preferred SBA lenders can rubber stamp their own deals and roll at a pace that the conventional banks who aren't SBA pre-approved can do. They've got to go through the local SBA branch, and that's always a heck of a lot slower. And I'll tell you horror stories. I've dealt with local conventional banks. Some are really good, some aren't. Some only meet once a month, once a quarter, their board to review deals. So if you miss that timeline, you're just sitting around waiting for nothing. Whereas with a lot of these preferred SBA lenders, their departments are actually always moving, always reviewing, always going back to underwriting, looking at the credit committee. They're moving forward. And there's great local banks too, like Gulf Coast Bank and Trust here in South Louisiana. They have offices here all the way into Florida. They've got their own SBA department that's pre-approved, that does nationwide lending. That's great. If you have a relationship with your local bank and they have that subsidiary as well, by all means, that's great. But if your local bank doesn't have that and they're not pre-approved, always consider looking at offers. Is the bank a preferred lender that can get stuff done? Because that is, as you said, Chris, it's so important, the speed and the time. We've dealt with deals with both, and I can guarantee you the preferred lenders always get deals done a lot faster on average. It's just night and day different. And the stress and time on a deal it takes is far less, allowing a deal to get done. And one thing also, Chris, their backroom staff is more prepared. Their underwriting team is more prepared. They understand the nuances of the SBA. Because remember, the SBA, for those of you listening, has their own criteria. Then the bank has their own criteria on top of that. And when the bank's back-end staff is synced with the SBA's requirements and what they're looking to do, that's how deals get done at a timely pace. It's the banks that have discoordinated teams. And you remember during PPP, it was an absolute mess. Everyone was looking at different regulations, different interpretations, deals grinded to a halt. When you have a bank that's competent with secure back-end staff, with veteran leadership, that's where you want to go. And if an offer comes in side by side, local conventional bank versus SBA preferred, good-sized lender, it's pretty much a no-brainer in my opinion. Seller can make their own choice, but that weighs very heavily. And we've seen that time and time again. I'll say too, when you get those banks and SBA loans, Chris, we talked about the speed. The next is the value it returns. SBA financeable deals tend to give a larger cash out to the seller. And buyers, for you listening, oh, you're not overpaying. What the SBA allows you to do is put your apples in a bag and present it and get it at one time. Whereas a conventional lender may want all these other stipulations, all these other issues. They may not be able to loan because there's, again, blue sky. They don't like blue sky. The SBA allows you to pay the value of the business what it's worth and get a deal done. And for sellers, yeah, they may want a 10% seller add back. A seller note holdback. That's fine. But you're going to get a lot more at close, and it's going to be wired and done. It's going to be easier, right, Chris? We see it time and time again. The SBA allows for deals to get done at the right price. Whereas I feel like conventional loans in the past, we dealt with a lot. If they're not very good at business financing, they end up just chopping a deal to shreds. You and I dealt with one earlier this year where the bank just came back at the last minute after the board approved the loan and wanted to chop it to shreds. Remember that nonsense? Like, it makes no sense how they operate like.
Yeah, this is why I think sellers need to evaluate the quality of the purchase price, not just the amount. Two buyers can offer you $3 million for your business, and those offers can have completely different economic value for you. If one requires substantial seller financing, the other can produce cash at closing, or the 10%, and the SBA is going to give you the other 90%. Price matters, but so does what you receive your money. Because if you've got to wait 5 years or 10 years to get your money, you're putting that risk that this buyer is going to be able to pay you back, that they're not going to fall apart in year 2 or 3, and that money's never going to be received. So you've got to look at cash out at closing, like you said. It's very important.
It is. And there's nothing wrong with a seller finance deal. We've done a lot of them in our tenure. And there are good tax benefits. But at the end of the day, there's still a bit of a roll of the dice, right, Chris? There's still a bit of that, I hope it works. And that's why we screen for the right buyers, and you do right deal structure, and you have the right lawyers draft the right legal documents. All that being said, there's still an element of risk and chance. And that's where, if you can have your eggs in your basket now, why would you not take them very often? I've had some sellers prefer seller finance. That's great. At the end of the day, there's a lot of factors involving, a lot of moving parts. Take what you know is a guarantee, which is that wire from the SBA is going to hit your bank account, and you're going to feel a lot better when it does. So let's talk about these new changes, Chris, because this is really what the focus is going to be today. We've got a lot going to affect October 1st. That's about 5-6 weeks away, folks. So a lot of you starting deals now, you're going to have to deal with these changes. If you've already got a deal in place through underwriting, you're probably going to avoid them. But if not, this is going to be the new reality for a while now until they decide to make changes and reverse anything back or whatever it may be. So let's talk about these changes, exactly what they are, Chris. First off, if you've got a deal that's at least $3 million in business value, not business and real estate, to be clear, just business value. You got a deal worth $3.7 million, $800,000 is real estate, 2.9 is business, doesn't affect you. If it's $3 million in pure business value, you have to have a QOV required now. And it cannot be a sell side QOV. I know there's been a lot of shift in the market, people using QOVs for deals. The SBA now requires a QOV on top of a valuation. And I think that's a very big game changer. Because for a lot of businesses, will they meet the stress test of that QOV? Because you and I know, Chris, sometimes accounting departments don't do a very good job. I was reviewing a deal doing 1.2 net last year. Minute tax returns came back at 800, net, way different swing.
Yeah, big change.
And a QOV would have found that probably. And we were looking at a $6 million deal, now looking at a 3.5, 3. So just be prepared. That's coming. The debt service, credit, debt service equity, it's 1.15 was the minimum. Debt service coverage ratio, it's now 1.25 for most deals. There is a couple of situations where they allow the 1.15 to hold on, but again, there's a lot of parts moving, and it's almost hard to comprehend because they've, instead of just doing a traditional one vertical explanation, they've now broke up into 4 separate kind of subsections of how they view deals, right, Chris? And I want to go over that real quick. First one, they have initial acquisition, business expansion, owner buyout, and ESOP and cooperatives. All 4 have different debt coverage service ratios. All 4 are different required for injections. But the single biggest change besides the QOV, I will say, Chris, is from now on, first-time buyers have to do a 10% equity injection, right? Before, there was a case where if you were in the same NAICS code, HVAC to HVAC in Louisiana, you didn't have to put any money down, regardless if it was your first transaction or not. Now, if it's just your first transaction, you're doing 10% down, right? Banks said SBA said no matter what, that's happening.
Yeah, and I don't think that's a bad thing. It's protecting the public interest, because at the end of the day, you have to remember SBA loans are basically government money, public money, it's taxpayer money. And so we're just protecting ourselves by making sure that the buyers going out there and buying businesses for the first time, that they've got the capital and the capital reserves, hopefully, to, buy the
Mm-hmm.
business to start with, but they need to have the reserves to. You're going to hit speed bumps. You're going to hit hurdles when you buy a business. Not everything's going to be roses and sunshine. So you've got to have the capital. And I wouldn't want buyers out there
Mm-hmm.
going in and being able to buy a business with zero down, because who knows what they got in the bank left
Mm-hmm.
to continue. So I agree with this change. I kind of like it.
I'm good with that too. And I'm not mad about the QV change either. I think there's some
No,
very good
no.
things with the larger deals because that's where the biggest swing in SDE can occur, or EBITDA, whatever metric you use. If you're looking at 100, 200 grand in swing at a 3.5, 4 multiple, that's $800,000 in some cases. That's a massive difference in the loan value and capacity to pay back the loan, which is what people forget. The SBA wants to know, can you repay this debt? And with default rates that were spiking at a straight vertical at one point this year, the SBA is just saying, look, guys, we got to tighten back. We just got to get through this curve right now. This inflation, interest rates, and a lot of these secondary seller notes kicked in, and it just caused a lot of chaos.
Yeah, I'm curious.
What it's really going to. Yeah,
I'm curious what these Q of E's are going to cost. Thinking about it out loud is
Mm-hmm.
it's like, because in the past, before the recent wave of Q of E people that have approached us, and they've advertised anywhere from
Mm-hmm.
$5,000 to $7,000, but
to 12,
yeah.
15 based on how many entities and how many moving parts.
Yeah, but before that, you on a $3 million business, I'm not saying you'd ever pay $15,000-$20,000, but it wasn't
Mm-mm.
uncommon to hear that quote coming out of somebody of if they wanted to have it done. And I know buyers who have
Mm-hmm.
paid, a little bit larger deals.
For bigger
they've
deals,
paid
yeah.
outrageous amounts of money for Q of E's. So I'm wondering how this is going to play out as far as buyers having to put up larger deposits, up front, because the bank's not going to cover the Q of E cost if the
No.
deal doesn't fall through. So, right now most SBA banks ask for what, couple $1,000, maybe $5,000,
At most,
$6,000.
yeah, at most.
I'm wondering if $10,000 is starting to come down the pipeline. That way they can cover their legal and appraisal and all that stuff, and they've got this Q of E over $3 million if it's required. So interesting to see how that's going to cause some heartache.
And let's talk a bit too about what that's going to do to the timelines of deals. Before, you have to move quick and keep things moving to get your deal along. This is one more third party introduced into the deal, required upon sellers providing documentation to complete their report. The SBA cannot move till this is done in deals of that size. And just note, the SBA said there's no accreditation required to do a Q of E. So when choosing your Q of E provider, that's going to be just as important, because anybody now can say there's a market share out there to be had to do the work. The question is, are they qualified to do them, right, Chris? Because there's no initials behind your name that says you're a Q of E provider that's certified. And the SBA doesn't care. They said that out loud. So you kind of have to tread a little carefully. Will demand spike for those and costs go up? That's a good question. And like all third parties into a deal, more timelines creates longer deal length, which can stress a deal. My concern also, on top of the cost for the average person, is being a sell-side one is not usable, a sell-side Q of E. Buyers are going to be forced to really put a lot of faith in their LOIs. You're going to see LOIs tighten up. You're going to see a lot more. What buyers say, I need more time to get due diligence done, because although a QV does a lot of due diligence for you, it's still more information a seller has to get ready at a faster pace earlier in the deal than traditionally done. And lenders can't speed that up. Let's add on another layer to that too. Let's say you have a $3.5 million deal, Chris, and the QV comes back and only supports it at 3. If you want to proceed further with that deal, that remaining difference is going to be on full standby if it's seller financed for the life of the loan, if I read that correctly. So you can still negotiate these deals at the original price, but are people going to want to wait that long, 10 years for average note life to get that back? I don't know, right, Chris?
Yeah, I don't know.
It's tough.
I don't know if that can be earning interest. I don't know what the rules and.
I think it's full standby. I think it can be interest earned from what I read correctly, but even then the rules were kind of vague. And again, the banks have to interpret their own position on this as well, how they're going to interpret the rules and what their requirements are going to be on top of that. And that's going to be something to consider, certainly.
Yeah.
And again, this is for $3 million deals and up. This is not for any deals below it. But if you're a seller out there, I know you're thinking, well, the buyer's to buy the QV, why should I pay for it? I would encourage you to consider getting a sell side QOV to get all that documentation done out the way and verify your cash flow. You don't want to go hand off to a buyer, and buyers is fair for you to get the QV, and it's required for deals that size, and find the cash flow is off, and then everything negotiated was off. So there will be some incentive for sellers, I think, to take that plunge and pay for a QOV up front and get that done. Granted, the bank can't use it, But if it speeds up your deal for you, that could be a massive change.
I can imagine that if you had a sell side Q of E done, I know the bank can't use it. The third party that's going to be doing the Q of E can't use it. But I imagine if you send them that documentation, it gives them a really good head start of what to look for, and kind of they still got to do their own thing. They still have to do their own analysis from scratch, but they've got a blueprint if they need it of hey, this is how we looked at it, and you can compare notes if you like. If that's not your style, that's not how you do things, I get it, but at the same time, who doesn't like a kind of a cheat sheet of this could help you kind of do your job a little better and a little faster, and if nothing else, it's use it as a second source of information to compare when you do finish yours.
You're correct. Let's talk again a little bit more about the 4 different categories I brought up earlier, because I want to make sure I cover this. I'm sorry, I'm checking my notes, folks, because a lot changed, and I'm making sure I don't make a mistake here when I read it. The biggest thing I see is for business expansions, and this is, I think, the one that's the most different than all the others. We said earlier, everything is a 1.25 debt coverage service ratio now. If you are doing, if I remember this correctly, a business expansion, so you're in the same industry buying your competition, or maybe you're expanding a different layer into your processes. It was at first, the 10% equity can be waived if it's a 1.15 debt coverage service ratio. That's the only one where it can be below 1.25 and hold the minimum bear standard as before. From what I understood, though, if you want the 1.15, you have to put 10% in. But if you don't want to put 10% down, it goes back to 1.25 debt coverage service ratio if you want to do no money down. Again, though, if it's your first-time acquisition, that doesn't apply to you. You still have to go back to the initial acquisition rules of 10% down. I will say, too, the only ones that don't require a Q of E, Chris, are ESOPs and cooperatives and owner buyouts. So 2 of the 4 don't require Q of Es, regardless of the size. Now, that being said, they did say no outsiders can make up 50% of the new owner base for our owner buyout. So it couldn't be, a manager buying out his boss and then getting a partner to come in, that doesn't work. It's got to be internal, more than 50% internal. So those are all good things to keep in mind. Don't be mad at us. That's not our rules. We didn't think of this. We're just the messengers right now. Another rule I do like a lot is one that we pushed back on a lot when the last SOP change back in like of 25 of June, I believe it was a cutback on the owner's ability to stay on post-transaction in a consulting agreement. Chris, they said it was only 12 months. And a lot of us got frustrated with that because a lot of times we build in deal value and owners and buyers agree. If I don't agree on the full price, but I'll pay you to hang around and help me and bring value to the company, that consulting agreement was key for a lot of people, especially for transitioning. They've expanded it from 12 to 24 months now, which is awesome. Or you can do 12 months with an add-on up to 24 months. That's great. I think that's a big win for owners and for buyers. But granted, that doesn't mean an owner can be an employee, a part owner, etc. That's just a consulting agreement. But I really like that rule change. I think that's a big win for a lot of people. And I think there's a lot of value that can be brought in there. Or it could be, look, hey, I want you around for possibly 2 years, but I know I need you for 1. Before it was after 1 year, you had to technically be gone. Couldn't be around at all. And I think that was compared to the previous rules before that rule change, that was a very big slam of the door back in the opposite direction.
Yeah, I think there was a lot of that still going on even before this rule change, just because there is no SBA police. There's no one coming around to check, hey, is the owner still around? Yeah, exactly. But it makes you feel better about doing the deal the right way and being on the up and up with the SBA right from the beginning of this is what we're doing. He's going to stay on past 12 months as a consultant up to 24 months. And so it always helps when you can be a little more, upfront and do things the right way than having to skirt around the rules and find the loopholes and everything.
You're right. Let's talk about some other little small changes too. For the first part, you can't use projections now to meet the debt coverage service ratio. So if you've got a deal that's kind of fluctuating and may not be there, you can't use projections to get it done. It's got to meet the debt coverage service ratio as is today. Let's see what else we got here. Valuations. Oh, that's another one. Before you could kind of order valuations at will. Now it must be lender ordered valuations. So you can't go the month before you sell your company, go to SBA certified valuation specialists, get a valuation done, have a deal brokered and bring it next week. The lender has to order it. So again, back to timelines. If you're above $3 million in your initial acquisition or business expansion, you're getting a Q of E done. Now you got to order appraisals. You got to order valuations. So I would recommend a lot of you out there, if you feel confident in the deal as it is right now, and you feel good about it, get with your lender and start ordering those valuations, start ordering those appraisals early because you're adding more layers of the onion you're going to have to peel back. And every time another person is brought into the deal, It's going to take time. And for example, we're working on a great deal right now for a landscape company here in town. Awesome deal. Order valuation, it came in instead of 1.1 at 700. Even the banker, the SBA preferred lender, was like, this doesn't make sense. It was it was not good at all. It was horribly recast. The projections were wrong. The trade in 12 months took 2 dead periods of a cyclical business and threw it into cash flow analysis. Well, no duh, it's not going to do well. You took away the main season, which we're in right now, and the current numbers are going to surpass last year's numbers. So how did that lender say it's not going to be debt coverage service ratio? I mean, that's not the lender, the valuation part. Like when we say it's going to matter more. Even with great deals, with a great buyer and a great seller and management in place and everything's lined up, more than well capitalized, these things can happen with deals. And that kind of a conventional lender too, don't get me wrong. But when we say get the process started early, get the process started early. Yeah. You don't know what's going to happen, right, Chris?
Yeah, for sure. You don't let these new rule changes discourage you as a buyer or a seller. In fact, just like Brandon said, let them prepare you earlier. SBA financing is still the most incredible tool for business acquisitions at this level. We just now simply have more defined rules about how the business has to demonstrate what it does and what it doesn't do for the buyer. If we know those requirements 12 or 24 months before a sale instead of 2 weeks before a sale, we have time to help you solve those problems as a seller. And if you're looking at it from a buyer, we can show you, hey, why this deal is SBA financeable. I think now when you see the stamp SBA financeable on a deal,
it's even more so.
You should be more comfortable even than before because it's got this higher debt service coverage ratio. It's got this higher requirement for buyers to come in with the right liquidity and all that stuff. So different deal structures, better transactions. I think it's going to be better in the marketplace. It might give some people heartache for a little bit as they work through these new changes and taking stuff to their lender and saying, hey, they're seeing why they're getting rejected if they don't read the rules closely enough, like you and I have. So, you're gonna see a lot of that. But for the ones that are reading the rules and understand it, you're gonna see a lot better deals going by. I think the Q of E is gonna slow the timeline down a little bit. I need to get through one where an SBA lender kicks us off to a Q of E. I want to see what that timeline looks like. Does that add 2 weeks to the deal, or is that adding a month to the deal? So I'm curious to how that's going to play out. But overall, I think these changes are positive.
I do too. And let's be clear, we're not mad at the changes. Obviously, there's always that period when you get the new changes, how to interpret them, how the banks are going to interpret it, how the whole market is going to react. Right now, what I tell you too, if you're a buyer and a buyer out there especially, if you don't have a good QOV provider and you're looking to do a deal in that range, you should start getting some recommendations from brokers of people they've used previously. Because remember, the SBA doesn't care if you have accreditation or not for QOV. They just want it done. So if your deal is going to hinge on the QOV being done, you want to make sure you have a good provider who you trust that's going to do a good job and stand by the work and not just throw, I hate to say it, shit against the wall. Because I've seen some documents done and I just shake my head. Like the valuation I saw, this is a very well accredited valuation guy who did a terrible job, who at least claims to be. I can guarantee you I would never use that person again for seeing the work that I was dealt with. And that's part of doing deals. Maybe it was a bad day for him, but it's going to happen. One thing too, Chris, not to scare people, but the banks are looking very hard now at add backs, even more so. They made a clear note in the new rule changes for debt coverage service ratio. They really aren't going to add backs into a lot of that unless it's extremely verifiable 1-to-1 ratio. So that means EBITDA's got to hold firm if you're going to meet debt coverage service ratio. And they're going to want about a 25% cushion on top of that. So if you're looking at a deal, that's going to be an issue for you. You better look at that and run that math yourself. And we're running that math as well. It's not like me and Chris over here, brokers, just going like, oh, we're not going to worry about it. We're going to have serious talks with our clients, current ones and future clients, that, hey, this rule change is coming in. We got to look at how this thing is priced and measured and make sure it meets these stress tests. Otherwise, we've got to get back to the drawing board a little bit on a lot of these deals and make sure we can make that work, because the new rules aren't going to allow for that. Or if there was some wiggle room, especially if you've been kind of having an up and down run the last couple of years, we got to rethink where that lending coverage is going to hit. And that's not a bad thing. Okay, that's a good thing. If the lenders are going to be more confident, they're going to be a little bit stricter, that means the deal is, I think, in my opinion, Chris, a better chance of surviving long term, correct? It's not like it's a hindrance per se.
Yeah. If it passes the new stringent requirements up front, it's definitely, as it passes through the levels and layers of getting a deal done, if you got a good start to it, it's got a lot better chance of finishing.
Yep, and just know, even more so, QOVs now, customer concentrations, poor accounting, it's really going to bite you harder than it has in the past. So if you thought you could just skimp by and handle bookkeeping and hand it off and not worry about it, you as a business owner need to rethink heavily where you are at in your process to sell, especially if you're over the $3 million mark in business value, because that's going to be even harder to do. There were some small changes to the lower end of the market. I know 350 and up were kind of a semi-loose loans with the SBA. Those are now considered full loans to go through the full process. So just know, even smaller deals, especially the micro loans as they call them from SBA, those are going to be under more stringent rules too. And it really hurt the cash flow because a lot of times small businesses need those add backs to get there. Because let's be honest, people run their lives through their business. So just if you're going to make a personal expense through the company, please, 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 please document, save receipts, save receipts, save receipts. You're going to need them more than ever, especially the smaller deals, because it may be the only reason you get out. And then we'll tell you too, I was reading a statistic yesterday, Chris. I think I even sent to you. I might have sent to you. The amount of lenders getting out of the SBA space is at a rapid rate. I think it's something like 35 or 25% of lenders that were previously doing SBA have not done a single loan this year. It's consolidating. A lot of smaller lenders who really probably got in because of PPP money and the low interest rates back in the day, they're getting out because of these new rule changes. And the SBA said, if you're going to rubber stamp a deal and you have a preferred status, you can't send it to our office anymore for a secondary opinion. So we're going to see some lending volume tighten up. That's going to happen. So get ready. It's not a bad thing. The market is resetting a little bit. And these new rule changes are going to help provide some stability. Anything we missed of any major consequence, Chris? I feel like we covered most of the major big points that are coming out. I'm sure more will come out in the coming days, but did we miss anything of any major consequence, or am I crazy?
Those are the main points I think that you and I identified as kind of a, wouldn't call them concerns, but definitely something to be aware of and make sure us as brokers are, aware of those on the front end, because if we're not aware on those front end, then we're not pricing businesses accordingly. We're shrinking our buyer pool. You got to know, like you said, the debt service coverage ratio going up is a great one. It's a good one.
That's the biggest one, though. That's going to be the most effective to people. Yeah. Yep. So again, we want to give you a quick update. Obviously, we're absorbing the new rules too. We're seeing how they're going to be applied, how they're going to be, timelines are going to be affected. Just know, for those of you out there, I'm going to repeat this one more time, and I'm going to get off this topic. And for buyers, this is key for you. If you see a big deal, $3 million up, with a sell side QV already done, that should be top of your list to look at, because that means your chance of getting the deal done is going to be expanded, in my opinion. And for sellers out there listening, when the broker says, hey, sell side QV may be important, don't take it negative as money out of your pocket. It's shortening your timeline, validating your cash flow, which means the metrics will hold up at stress tests. Debt coverage service ratio, buyer QOV, lender valuation. That's going to save you time and money. For the minimum amount you're going to spend, like what, Chris, maybe $6,000 to $10,000 for a $3 million deal, that may secure your $3 million versus jumping you down to 2.7, 2.6. That's a massive amount of return in money saved. And same for buyers. It's going to save you money if there's a bad deal or bad representation as far as the books are concerned. Just be prepared. And if you need a QV provider or you need recommendations, Chris and I have several people we've used in the past. We're happy to recommend them to you. I know these guys are gearing up for a whole bunch of work coming their way as well. And honestly, predictions, Chris, I'm going to ask you a couple. I would not be surprised if we see QV threshold drop to $2 million in the next year. If this is successful on the default rates in a year or two, watch it drop it down another tier.
Yeah. Just watch out for that. The cost of QOVs is typically high, and I wouldn't want to see QOV providers reducing their rates to get it done quicker or more efficiently. QOV is there for a reason. It's to really qualify those earnings and make sure, it needs to be a really good stress test. It shouldn't be going through an assembly line of QOVs, and that's what I'm a little concerned about is whether this just becomes a checkbox. Sometimes real estate appraisals are like that. You put a real estate appraisal out there, you tell them you need it. What's the asking price? $2 million. Appraisal comes back at $2 million. It's crazy how
$2,005,000.
I don't want to see QOVs just all of a sudden we're just paying QOV providers to make us feel better.
Rubber stamp.
Yeah, exactly. So hopefully they'll hold the standard. But things have a way of becoming more efficient and less costing less over time. So we'll see what happens.
You're absolutely correct. And one thing I would encourage buyers to do as well, while we're sitting here talking about how to prepare, if you're serious about buying a business and it's going to be at that $3 million threshold, get with the preferred lenders now. We can recommend great ones to you as well, and talk to them about what they're going to need from you. Because a lot of this seems to be seller focused, But in reality, it's really buyer focused on what they can afford to give the buyer leverage to buy. So talk to these lenders, get pre-approved, as Chris said, speed up your timeline, but also make sure there's not any new requirements that are going to be affected you directly that the lenders are going to want to get out the way early and that we can then maximize, when presenting your offer to be competitive. And I keep hearing all these influencers, we talked this too, the silver tsunami and all this competition for business. Let's be honest. A majority of Main Street level businesses under $3 million are not going to have 40 people bidding on them. They're just not. Like, I don't want to be a Debbie Downer. Now, granted, we have a valve company we took on 2 days ago. We have 35, 40 leads in 48 hours. Some of them will be hyper competitive, and we've told some of the buyers coming in, if you're not SBA pre-approved, you're not in the industry right now, you're probably not going to get a shot at it because we've got that many qualified buyers showing up. So just keep that in mind. That is coming. So with these new rule changes, be on top of it, be prepared, get pre-qualified. If you have questions, Chris and I are here to speak to you as well. We love educating, we love helping you, and we want to share this information with you so you can be prepared. That is the single most important thing, right, Chris? If you take the time to do your homework beforehand, your chances of a deal getting done go up dramatically, right?
Yeah. And hopefully this will put an end to all the gurus who tell you you can buy a business with 0% down.
Because guess what? They said 10% no matter what. They made it abundantly clear that bullshit is not going to stand.
Yeah, that was barely happening before. It was like less than 1% of the
time
a joke. Happening. I never even heard of one, but I'm sure it was happening if they were preaching it as much as they were. But you can put that to bed.
That's pretty much dead. That's correct.
Yeah.
Well said, Chris. We didn't even highlight that, but you're exactly right. They basically cut that out. And I'll say this politely, too, to the searchers out there who are being backed by other people. They put a lot of hard criteria on you, too, because a lot of this other the equity injections now, if you don't have the cash, those notes are on full standby. And if you're a minority investor, ownership person, but you're putting up more than 50% of the down payment for the equity, they're tying you into the full thing, too.
Yeah.
So we're going to see a lot of that market share drop off. Because honestly, I wouldn't put money up, take the full risk if I'm not getting, guarantee, right, Chris? I mean, come on. I'm not guaranteeing all that whole if I'm not running the company.
No, and those funds that they're requiring you, they have to be seasoned. What is it, 60 days, 90 days? I don't remember what the requirement on seasoned fund is.
And there's a 6-month trail back on citizenship, too. They're going to check that as well. So if you just recently got it, they're going to check back on all that. Your investors as well.
Right.
And also, too, if the money's not free funds. I forgot to mention this, Chris, real quick. We did forget this. If you have to go borrow money for part of your down payment, they're going to scrutinize that very hard and put that in a standby position. There's a whole bunch of stuff in that criteria that's changed that I'm not fully sure how the banks are going to want to interpret that, because they may not even say we don't want to deal with it. The SBA says it can be done, just like you could do no money down, but do the banks want to do those deals? No. Let's be honest. They just don't. So be prepared, get capitalized, do your homework, get ready, and call us. And we're happy to help you.
There you go.
I hope you're informed. Man, that's everything, Chris. We did get all done. I'm sorry. For those who thought we said we're done twice, we just keep going because we love to chat and tell y'all more good stuff. I'm sorry. Anything else, Chris? I think we hit it.
I think
this
you got
time,
it.
final time.
Final time. You got it.
Final time. All right. Well, on that note, I'm Brandon Bourgeois. That's Chris Sater. We look forward to hearing from you. Subscribe, like, share. We love to get feedback from our guests and from our listeners. And on that note, we will see you next week on the Steps to Soul podcast. Y'all take care.